Hi traders, you're welcome back to the Forex Geek channel. Now in this video, we're just going to be breaking down the double RSI divergence trading strategy, okay? But this particular divergence strategy involves multi-time frame analysis, okay? It's a multi-time frame, regular plus hidden divergence trading strategy. This approach combines reversal and continuation signals across multiple time frames to give you stronger, more reliable trade setups. Okay, we're going to cover the chart setup, how to identify each divergence type, and the exact rules for entering and exiting your trades. Meanwhile, let us start with the basics. Regular divergence occurs when price makes higher high, but the RSI makes lower high. So we're going to be adding the RSI to the chart right away. Divergence is a pretty easy strategy to use. You just need to understand the concept and you'll be able to apply it effectively. Okay, so basically, when you have price making higher at any point in time, when you find out that price made a higher high, just like what we can see happen here, and the RSI made a lower high, there is a possibility that that bullish momentum has started getting weak, okay, and we might have a reversal. All right, so that is for a regular bullish divergence. You can see in this particular case, right after the price made higher high and the RSI made lower high, we actually had a bearish move. Okay, a bearish move followed. Now this have to happen in an uptrend. Okay, it has to happen in an uptrend for it to be a valid reversal. Right now, in the case of a regular bullish divergence, when price makes lower low, all right, when price makes lower low but the RSI makes a higher low in a downtrend, when price makes lower low but the RSI makes a higher low in a downtrend, it's a bullish divergence. Okay, a regular bullish divergence showing that a bullish reversal could be imminent. All right, so I'm just trying to find a good example to show you. Okay, let's just go to a higher time frame. Let's see if we're gonna find an example there. Okay, sometimes a divergence signal might not, appear all the time. So if we do not find a bullish divergence within a few seconds, now we're just going to proceed. Well, the main thing is for you to understand the concept. Okay, I think we have found one now. So like I said, price has to make lower low and your RSI has to make higher low. Okay, so this is what we call a bullish divergence, a regular bullish divergence, because after this signal is seen, there is a likelihood of price reversing to the upside, and you can see that is exactly what happened here. Okay, this suggests that the pullback might be over and the trend you know is, or rather this suggests that the ongoing trend might be over, and the trend is about to reverse to the opposite direction. Why hidden divergence is the opposite. Okay, hidden divergence supports the current trend. So if you are in an uptrend, the price will make higher low while the RSI will make lower low. Okay, So that is a hidden divergence. Hidden divergence is a continuation pattern. For example, now this is an uptrend, right? Price would make higher low, as you can see. The RSI would make lower low. So this is a hidden bullish divergence. It shows that this bullish trend is going to likely continue. All right, is it likely? There's a likely chance that this bullish trend will continue because of this hidden bullish divergence. Then in a downtrend, for a hidden bearish divergence is when price makes a lower high. All right, when price makes a lower high, but the RSI makes a higher high. Okay, let's see if we can find an example. When price makes a lower high, but the RSI makes a higher high. So basically, that is a hidden bearish divergence. That suggests that the pullback might be over and the trend could continue. So when you can spot both the regular and the hidden divergences and you know how to combine them, you gain a real edge. Okay, now for this strategy, you should be using 2 time frames, one higher for trend direction and one lower for entries. Example, if you trade on the 15-minute chart, you can actually check the 1-hour chart first. If the higher time frame shows maybe a hidden divergence in the trend direction, then you can drop down to the lower time frame to look for a regular divergence for a precise entry. All right, you get the point? On the 1-hour chart, you can be looking for a hidden divergence. Remember that the hidden divergence is used for trend continuation. So if you find the hidden divergence on maybe a bullish hidden divergence on the 1-hour chart, and then you drop down to the 15 minutes, of course, the lower time frames have more price activity, right? So you might see a trend reversal that supports the 1-hour time frame. Maybe there was a bearish move on the 15 minutes, and then you found a bullish regular divergence, whereas on the 1-hour you found a bullish hidden divergence. In that case, that's a good opportunity to enter your buy trade. So this way you are trading in sync with the main market move while catching the best possible timing. For trend continuation trades, confirm a hidden divergence on the higher time frame in the direction of the trend. Then you wait for your price to align with your bias. Then on the lower time frame, you look for a regular divergence in the opposite direction to catch the pullback's end. Enter when the divergence completes and the RSI turns back toward the trend direction. Then for reversal trades, you confirm a regular divergence on the higher time frame. Then you drop to the lower time frame and look for another regular divergence to confirm momentum change before entering. Always wait for candle closes, okay, to avoid false signals. Then for your exits, you can use recent swing highs or lows as targets depending on your trade direction. For example, here that we had regular bullish divergence. If you are going to enter a buy trade after you get a candlestick confirmation, of course, your stop loss can be below that pattern, and then your target can be around key zones, perhaps resistance zones. All right, important key levels can be used for your targets. Then in the case of a sell trade, you can use important support levels for your targets. Okay, you can also decide to trail your stop losses if you wish. All right, if RSI moves into extreme zones, and starts turning, maybe the overbought levels or the oversold levels, and starts turning, you can consider scaling out or closing completely. The key is to protect your gains when momentum slows. All right, keep your risk at 1 to 2% of your account balance per trade. Divergence can be powerful, but it is not foolproof. Okay, ranging markets can produce false signals, and that is the reason why multiple time frames help filter noise. So always combine divergence signals with strong price action levels for even more accuracy. By combining regular and hidden divergences across multiple time frames, you are stacking probability in your favor. Practice spotting these setups on historical charts to train your eye. If you enjoyed this breakdown, Click the like button and subscribe for more trading strategies that can sharpen your edge in the markets. Thank you for watching, and I look forward to seeing you in the next video. Happy trading.